Have you ever looked at a real estate deal and thought, man, if I had access to more capital or the right partner, I could have made that work? Or maybe you've got cash sitting idle and you're tired of the same old stock market roller coaster, wondering if there's a smarter, safer way to grow your wealth. If either of those sound familiar, today's episode is going to blow your mind. Welcome back to another episode of the Vital Wealth Strategies podcast, the show where we help high-earning entrepreneurs build and protect lasting wealth with strategies that the mainstream never talks about. I'm your host, Patrick Lonergan, and today I'm sitting down with Dave Kotter, the founder of Hybrid Debt Fund and Integrity Capital, and someone who's rethinking how real estate deals get funded and how savvy investors can get a piece of the action. Whether you're a developer looking to move quickly on a deal without jumping through the bank's red tape, or an investor who loves the idea of being first in line on a secure asset and earning equity-style returns, you're going to want to listen all the way through. In this conversation, we dig into how Dave's fund gives real estate operators access to fast, flexible capital and gives investors the kind of risk-protected upside that's hard to find anywhere else. You'll hear how they structure deals, how they manage risk, and how they're filling the gap that traditional banks are leaving wide open right now. And here's the best part. We're not just talking theory. We're giving you a behind-the-scenes look at how seasoned investors are finding asymmetric opportunities where downside is protected and upside is almost unlimited. Now, if you're listening to this because you know you're overpaying in taxes or feel like you're missing out on strategies the wealthy use every day, we've built something for you. Head over to vitalstrategies.com/tax to start building your custom strategy. It's where we share the exact tools, frameworks, and little-known tax plays that are saving our clients hundreds of thousands of dollars every year. And it's where your next smart move begins. All right, let's jump in. Dave Kotter, thank you so much for joining us here today. I'm excited about this conversation. We're going to get into, debt, which is good. It's how businesses grow. We look at the any kind of leverage just allows us to grow. And also thinking about on the other side of the equation, I've always wanted to own a bank, right? I love the idea of, deploying my capital and earning interest on it. And so I think we're going to get into all of those things today, but thank you so much for joining us here.
Thank you for having me. I'm excited.
Yeah. So I think through, some of the problems that the entrepreneur has, and I think there's two ways to look at this. And we're going to start off on the debt side. Traditional financing options are hard, they're slow, they're bureaucratic. I feel like I've got to turn over, blood samples and my first child. And it can be just frustrating that, the lenders don't understand the entrepreneur, the speed they need to work at, the real estate opportunities out there and how quickly we need to move. And then, I don't know, I also feel like, philosophically, capital shouldn't be something that shackles us and slows us down. It should reward competence. We think having a financing partner that knows how to handle those things is good. So I think that's one side. And then the other side is, I just look at where my options are for deploying capital and I can put it in the stock market, but that sounds somewhat risky, right? Like I don't have any control over those businesses and they go up or down. Where if I can have some peace of mind about putting my capital out there and getting, a consistent rate of return back, it's like that is more exciting to me. And it doesn't feel fair that I'll say the big players get all of the advantage with the opportunity. So I think it's going to be fun exploring these things. Can you tell us a little bit about your business and how Hybrid works? And that'd be great.
Yeah, 100%. So just as a quick foray, I've been in the business since June of 2003. So we've been financing commercial real estate, over 22 years now, I guess. I've done over 500 deals. We've done over 2.1 billion. And we decided a couple of years ago that, through this experience, to one of the points you just mentioned, is that this is a very archaic business. You're talking about banks and all these different groups that, hey, they lend a lot of money. The challenge is the red tape, the slowness, and it's very difficult to walk through quicksand. So we decided that we want to do a couple things, do a fund that we could start to build a process that was much more streamlined, expedient, and actually give the ability to not have things that don't matter in there. Plus, we wanted to also have something that was niche-y, unique, and different. We didn't want to just be a private money lender. And so this is really what is considered a stretch senior loan And so if you think about when you go in, you get a 65% loan, you raise the rest of 35%, whether that's pref or common. That's
Mm-hmm.
the normal deal. What
Yep.
we do is it's a spinoff of a couple life companies do this, which is what's called a participating mortgage. So what happens is we take a first deed of trust, we stretch it all the way up the stack, and we could go up to 90%, sometimes even higher.
Hmm.
And it's one loan. We have the first deed. We are not in the limited partnership at all, so we don't have ownership. And so what happens is we do a 3-year note, and we do it on construction and bridge
Mm-hmm.
situations where there's upside. And then we take a 30 to 35% upside participation with the developer. So that means that when you get to cash flow, if you do during the time, we take 35% of that. If we get to reversion, we take 35%. It's not complicated waterfalls. It's just straight
Mm-hmm.
35% reversion. And so what it does is it offers and solves for the problem of a couple things. One, you know as well as anybody that when you have to go tie up a property, then go figure out debt, then try to coddle together, like there's so many moving parts
Mm-hmm.
that how can we consolidate that and simplify? And then also it provides for somebody not to have to try to go give as much away to somebody as well. So there's a lot of benefits that I can go to. That's the genesis and the impetus of the hybrid debt fund for this specific product.
Yeah, yeah. I think this is fantastic because I think there's so much opportunity out there to take advantage of deals. But like you said, the slowness of the process, by the time you get it all together, like the deal falls apart. So just to get some clarity on how these opportunities work out,
Mhm.
are you looking specifically? So these are development deals, right?
Uh-huh.
Like it's a project that is it typically ground up? Is it
Yeah.
I'm going to buy this, old building and gut the thing, renovate it completely? Like, is it any kind of development?
Yeah.
Can you give us some
Yeah.
specifics on those types of deals?
Yeah. So I would say a couple of food groups. So
Hmm.
apartments, whether that's ground up construction or rehab. Our preference is rehab. And the reason why I say that is just because we can get dollars out quicker. We're
Hmm.
not having to go through the slog of construction, but we'll do it.
Yeah.
Retail is at the top of the food chain right now. So retail rehab or retail construction. Industrial, small bay industrial too. It's a big fan of
Mm.
that. And we can do medical office. I would say we could do storage, although that's a little tricky ground up just because it's a longer process. Takes usually 4 years, gets tricky on some of the IRR hurdles. And then the ones that we're really starting to explore now that I'm a big fan of is mobile home
Mm.
parks and even RV. And ironically,
Yeah.
I actually we develop RV parks. So I understand that world a little
Yeah.
bit as well. So yes, those are the food groups, and we can do construction and rehab preferences, rehab
Yeah. Got it. And just to
preferences.
reiterate, we're typically looking for projects that have
Correct.
a value of $5 million and up. Like when we're all said and done, we need to be at least at that threshold. Otherwise, it just doesn't make
Yeah.
sense to get involved.
Yeah.
Yep.
Our scale is 5 to 15 million in loan sizes typically. So you could
Hmm.
end up around 18-ish, give or take, but
Yep.
yeah.
Yeah. Great. Now, you highlighted something that I think is important, and I'd like to dig into that on maybe all the different food groups. So one of the things you said was we develop RV parks.
Hmm.
I'm fascinated by RV parks. We went and visited a friend that rented a space and rented an RV and parked there because their kid wanted to like enjoy the weekend camping. And I was like,
Yeah.
the place was packed. It was insane to me. And there was, I don't know. I was just driving around looking at the business model and I'm like, this is so interesting. So
Yeah.
the reason I bring that up is you have experience in RV parks, so you're comfortable making loans on in that side of the equation.
Hmm.
Can you tell me how you manage the risk on, I'll say, eh, the multifamily, because being in the real estate game myself, we look at there's good deals,
Yeah.
and then you need execution to make it
Yeah.
all come together, right? Like you have to have somebody that's on top of that development and making sure it's on schedule, on budget. Otherwise, the whole thing starts blowing up. And so,
Oh, yeah.
how do you make sure that those things all work themselves out?
It's a great question. I would say our philosophy, and this has been formed over the 22 years, we always start with the sponsor
Hmm.
because I'm just a big believer that it all starts there. That sponsor that is really dialed in and understands their craft, right? They
Hmm.
become a little bit of a geek around it. They know their backyard. They understand the neighborhoods and what's a good area, what's
Yeah.
not.
Yeah.
They are financially sound, meaning that, they have the appropriate net worth, they have some cushion with liquidity. So to me, it always starts with the sponsor because that is the person who does the due diligence. That's the person that's going to execute or not execute
Hmm.
and have the makeup, I'll say, the
Hmm.
design to really already be wired to say, I'm going to be executing and managing this. Otherwise, it just flops. The second component, obviously, are the economics. So for us, the way we mitigate risk for our investors is a couple ways. That's the first one. The second one is we look at the economics. So we always look at what is the delta between the yield on cost that you're developing to and that exit, what your estimated exit cap is. We have to have about 150 basis point or higher
Hmm.
spread just because we know that things don't go as planned. There's got to be room for error. I know that
Yeah.
sounds surprising that things don't go as planned in
A construction project, right? Yeah.
shocker.
Yeah.
So
Mm.
just having that cushion is really, really important. And then we
Hmm.
obviously go to that third layer of what I would call the wave that you can't control, right?
Hmm.
So if I go into an economy or a location where feet are coming in and you have jobs that are coming in, it's just moving in a direction that's way
Hmm.
outside of your control. And so those are the things we're saying. Are we in the path of growth that's just going to take its natural course? Or are we going to a place that's dying off or just doesn't really have anything for that matter? So those are things that we tend to look at to start, and then you start getting into little nuances, but I'd say overarching, that's how we try to mitigate risk at the end of the day.
I love that. And that's one of the things we've talked to our clients about. We've had clients approach us saying, "Hey, can we be invested in some of your deals?" And we've sort of pushed against that just because I sort of like to keep. We've got one deal that we've had people invest in, and it's worked out fine. But uh, I'm I know the deal that we open up to people will be the deal that blows up, right, in a bad way, and it'll be like, well, dang it,
Oop.
right. So we always tell people go find an operator, somebody that's really good
Mm.
at their craft, just like you said. And then second, I think the numbers matter, right? Like looking at the pro forma, and not just the pro forma, but is there realistic
Yep.
data in there? Is there realistic assumptions, right? And I think having somebody that can help analyze those, that's seen a number of deals, is critical to the equation. And then again, economically, are we investing in a place that is trending in the right direction versus
Hmm.
like dying a slow death? So that last piece leads me to a question: is there areas of the country maybe that you're
Sure.
like, it's hard to invest there because the economics don't work out as well as over here?
Yeah, it's a great question. And I think it depends on obviously, the location, the time frame we're
Hmm.
in. Like, for example, right now in Phoenix, if you had bought, I don't know, a year or two ago for an apartment complex, probably not a great time just
Hmm.
because the rents are soft. You have oversupply right now. Flip that narrative a little bit. If you're going in to develop right now, probably
Hmm.
not a bad idea because what's going to happen is when we get to the end of 26, that is going to flip where now
Hmm.
there has not been construction going on for the last 3 years.
Yeah.
And so, there's a little bit of strategy that goes into there, I would say, depending on, that submarket and so on
Yeah.
and so forth. So those are areas. I would say there's areas in Texas
Hmm.
that are a little concerning. I mean, you get into like DFW, it's good, but then you start to get on
Yeah.
sort of these outskirts. I've looked at a couple things in Midland and I'm like, I don't know. It's just you get into oil boom and bust. All
Yeah.
of a sudden things go up and then they can crash real fast. So in tertiary markets, I'm not necessarily afraid of them. I would say there just has to be a really good story of why,
Yep.
what's the justification? Because when things get soft, that's going to be, obviously there's parts of California that you're kind of like, I don't know, maybe not. Uh,
Yeah.
you know,
Yeah.
I hired a couple of people out there and I'm getting like tax bills I'm like, why did I do that? So, there's areas that
Yeah.
definitely have a question mark on them for sure.
Yeah. Yeah, no, that's great. And one thing that I never really thought, because we've been investing in real estate for over 20 years, I never really thought insurance was going to be a factor. And when you bring up
No.
California, I'm like, man, the cost of insuring a property is expensive. If you can get coverage, it really is interesting. So yeah, the economics definitely make a difference there.
Yes.
And one thing you highlighted that I remember reading this book probably 20 some years ago, and it talked about building permits, and you could almost see and they liked this book's methodology was around, we'll say, major metros with a university, key
Mm,
employers, that type of thing. And it was like every city will go through ebbs and flows of building, and then it's oversupplied, and then no building permits are issued because people are like, oh, I can't, now is not the time to build. And then when that is at a trough, it's like, okay, now is the time to start the development process.
mhm.
And I think you highlighted that with the Scottsdale example. So I think there's a lot of wisdom to that. I think it still holds true today.
Yeah, I call them wisdom wounds. So if you can see my gray hairs, they all have a story to them. That's
Hmm.
where part of the advantage of coming in with someone with more gray hair, they go, I've seen that rodeo before.
Yeah, yep. And my hair all fell out, so it's
Who knows which one's better, right?
that's right. But I've learned just about every lesson in real estate on what not to do by just
Yeah,
screwing it up, personally. So
totally agree.
real quick, before we get back to the conversation, if you're listening to this thinking, I want to do more with my money, I want to grow, protect it, and stop watching so much of it go to taxes, you're not alone. At Vital Strategies, we help high-earning entrepreneurs like you design custom tax strategies that free up cash flow and create long-term wealth. And the best place to start? Head over to vitalstrategies.com/tax. It's where you can connect directly with our team and begin building a strategy tailored to your business, your goals, and your lifestyle. If you're ready to stop overpaying and start using the strategies the wealthy already know, visit vitalstrategies.com/tax and take the first step today. Dave, we've talked through how you sort of mitigate the risk. Now,
Mm.
can you talk us through, because I think it'd be interesting to talk through the other side. Okay.
Mhm.
So um, I'm an investor and I'm like, hey, I like the idea of investing in these projects.
Mhm.
And can you walk us through what that looks like?
Yeah, so for an investor coming in, and this is part of the reason we fell in love with this, is that, when you invest in something, it's always, people say, well, I'm making X amount. I'm like, well, that's good, but you always have to look at what is the risk adjusted return? Like, what
Hmm.
does that mean? And what kind of risk are you taking on? So if somebody
Hmm.
comes into an equity pool for us, and it's obviously Reg D offering, someone has to be accredited investor.
Hmm.
But what happens is they come in, and for us, that equity pool is what ends up taking the first deed of trust against the real estate. So it's here you have this secure instrument
Hmm.
against the real estate. Someone gets a consistent 5.5%, income that is paid out quarterly. It's just sort of ebbs and, that's what you get.
Hmm.
And then what happens is when we go to reversion, whether that's the cash flow and or that 3-year mark comes up, then we end up doing a pro rata share that goes 80/20. So we do an 80/20 waterfall to the investor that goes up to 13, and then everything after 13, it's a 50/50 split. So pretty
Yeah.
simple, not too complicated, but the benefit is you get the benefit of having a deed of trust, a secure instrument against a property that if
Hmm.
things go south, you can foreclose. Hopefully that never
Yep.
happens, but you have the ability and control. You
Yep.
don't have the risk and the legal risk of being in the equity side of it as well.
Hmm.
And
Yep.
so you mitigate that. Plus you get that pop, that upside that
Hmm.
you get to share with them. So it's a little bit of the best of
Yeah.
both worlds, where somebody comes into multiple projects as well. So that's the genesis of how it
Yeah.
works for the investor.
Great. And just to clarify and maybe ask a few
Yeah,
questions there.
please.
So a deed of trust and a mortgage,
Mhm.
what we're saying there is I'm in a first position from a
Correct.
collateral point of view,
That's
right? So
correct.
if I think about the first rule of lending, it's
Hmm.
collateral, 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 and maybe first, second, and third rule, right? And so we never want to put money into a deal that we think is going to go bad.
Yeah,
Okay. But the reality is sometimes they do.
they do.
And so it's
Yeah.
like, let's look at the worst case scenario and how do we protect ourselves? And the way you protect yourselves is you have a collateral position that says, cool, I'm first in line, right?
Hmm.
Like if this deal goes poorly, I foreclose, all of the rest of the equity can do one of two things. They can come pay me off,
Hmm.
or I just get the asset with all of that equity sort of baked in. So I just wanted to highlight that piece because I think that's awfully valuable from understanding the risk profile, right?
Yeah.
I'm in a different position here when the certainty that I think of Warren Buffett. Warren Buffett says the first rule of investing is don't lose
Yeah.
principal. Second rule of investing is don't forget the first rule. And so like that's what you're doing here. You're protecting that principle. And then also when we start thinking about, the additional upside layers on top of that, it looks attractive. So good. Anything else to add to
Yeah.
that?
I think it's important too. It's interesting. You talked about stock market earlier. I just did a little piece on this that's coming out next week on, the stock market, and I'm not hey, it's this or that. I mean, people
Hmm.
do it all the time. I've done it myself, but just
Yeah.
as a supplemental thing. I mean, you look at the private credit
Hmm.
market, it's a really interesting market. It's 2.1 trillion. We are considered a private credit instrument, but there's a distinction between most private credit are against businesses or credit cards. So
Hmm.
that is a very nuanced piece of this is to know that like, yeah, you do have collateral that is tangible that you could actually do something with as opposed to in the stock market, you don't. You're just kind of floating around in space. So I think it's important when people do their due diligence to really understand like, what am I investing in? What's the
Hmm.
collateral? What does that look like? Risk
Yeah.
adjusted returns. So yeah.
Yeah, that's great. And then one thing to just clarify, when I think about the investment, am I investing in a particular project? Is there 5 projects? Is there 20? When
It's
I put in my investment, how does that
correct.
get
Yeah,
work?
it goes into multiple projects. Obviously, we're in the genesis of our fund, so it's going to start here and go to here.
Hmm.
But the
Hmm.
idea is that it's going into an expansive pool of deals. So that's what we are doing is building a pool of deals that someone's going into that's spread amongst multiple
Yeah.
things, which is the idea of diversification.
Yeah. Yeah. I like that for a few reasons. If one deal goes bad, now I'm protected in that deal with
Mm.
my first position, but it can take a minute for me to get my
Yep.
money back, right? Just going through the process. But when I've got that spread around, that spreads out the risk. And then another thing that I also think is interesting is I've gotten into deals that I'm like, this deal is the best deal I've ever done. And it works out to be an average deal. And then I've gotten into deals, I'm like, this is a pretty good deal. And it can turn out to be a home run.
Oh
And
yeah.
so it's like, I never know
No
if they're going to work out. There's luck involved, there's all sorts of interesting pieces. So,
variables.
yeah,
Well,
yeah.
and I think from a risk perspective too, what we've done is so let's say that something doesn't go right, we actually bake into a loan loss reserve. So that
Hmm.
gets built into this bucket. So if all of a sudden there was a default, it first goes to that loan loss reserve, right? Then it flows over to the management company up to their contribution. And then the final is back to the investors, right? So it sort of goes through this process that you have to. There's so many layers of things that happen before something goes completely off the rails. But
Hmm.
you just have to think through those things. And when you first get into it, you try to look at. It was funny. I was just on the phone with a vendor, and I was laughing because they were presenting something to me, and it was not accomplishing what we wanted at all. And what she said to me, she said, "Well, I think you just need to be really positive." And I looked at her and I said, but this isn't accomplishing what I did. So I said that there's a difference between being optimistic and delusional. And so there's this, I said, I'm a realist. So you just
Hmm.
have to walk through like what could potentially happen here outside of an act of God that you could really get your arms around. And that's just a little bit of how my mind works. So
Yeah, no, I love that. So there's a few different things I want to think through. So the next thing is, so I invest my money in a deal.
Hmm.
What does the communication look like? What
Yeah.
can I expect from I don't know,
Yeah.
reporting,
Yep.
updates, that type of thing?
Yeah. Somebody comes into a deal, they make a capital commitment that does a drawdown that starts the clock on the returns. We communicate every quarter, so they get all the communication, what's going on in the fund, they get all the financials, everything gets uploaded into a portal. So they get to go to this nice clean portal where they get all their reports, they get everything on a consistent quarterly basis. So they know what's happening. Plus, they get all of their K1s and everything goes into a
Yeah,
portal.
yeah,
So it's nice and centralized, it's communicated real clear, and there's a cadence to it. There's probably more frequent communication than that, but that's the
hmm,
tagged quarterly communication. So people know what's going on, plus they know where their money's at.
sure. Yeah, and I think that's good, and especially with development projects, it's like there actually isn't that much information that can be distributed. It's like we're
Correct.
still on track, right? Still
Yeah.
on budget. I think that's good. So we always love the tax angle. So
Sure.
I don't believe there's probably a huge tax angle outside of maybe investing. I could see if I had, $250,000 in my Roth IRA, and I'm like, hey, this could be a cool opportunity
Hmm.
to, invest those dollars tax free and get some really good upside. But I don't assume that I'm participating in any of the, we'll call it depreciation, or any of the tax
No.
benefits of the underlying real estate. It's debt. So,
Yeah, this has been an interesting discussion because there's this tension point of like we're not in their LP, so we have withdrawn ourselves from the risk.
mhm,
We've also withdrawn ourselves from the benefit of the depreciation.
yeah,
So which one do you do? For now, we've just said that's better suited for the investors. We
yep,
also are considered additional interest, right? So it's really ordinary income at the end of the day. It's not capital gains. One of
mhm,
the things that we have not quite cracked the code, but we're getting closer, is if there's an opportunity for us at the very last minute to clip into uh, what would be called non-binding ownership at the very last minute. So all of a sudden it turns into capital gains. It's
mhm,
something we're trying to figure out. We actually looked at a warrant
mm,
and it got way too complicated. I was just like, after about, 6 iterations, I'm like, this is going to get way too complicated to try to
mm,
figure out a
yeah,
warrant. But anyways, for now, that's what it is. We are trying to work towards something that might turn it into cap
yep,
gains. We'll see.
yeah, yeah. No, that's great. And I one of the things that we like to do for our clients is work on that income tax number, right?
Mm-hmm.
And so on average, we're saving our clients $280,000 a year in income
Mm.
tax, and typically they're running out of cash flow before we run out of strategies.
Yeah.
So it's like, hey, if you're kicking off new cash flow, it could just open up new opportunities for people to
Mm.
offset some of that income. Now, we do love our capital gains tax strategies
Yeah.
as well, but they're not as regular as the income tax, right? The income tax
Correct.
shows up every year,
Yeah.
whether we like it or not. So
Correct.
very good. Let's see. So I'm just thinking through, if somebody's listening to this and they're like, Dave, this is a fantastic opportunity. What would next steps be? How would they
Yeah.
go about sort of learning more and getting plugged into the process?
Yeah. A couple of ways. Easiest one is go to hybriddebtfund.com, which is HYBRID debtfund.com. The other one is just to reach out to me at dave.kotter@hybriddebtfund.com. And either one of those ways, you can connect with us to walk through the process. There's stuff on the website that you can download to get more information as well as connect with us personally.
Yeah, no, that's great. And we'll have links to all of that in the show
Yeah.
notes. And Cotter is spelled with a K, not a C. So that's
Welcome
and
back. Welcome back, Cotter.
that's right. It's good. Yeah, because I think this is a fantastic opportunity. We have clients that are regularly looking for new opportunities that aren't in the traditional mold. They've got excess cash flow and they're like, hey, look, I can tie it up for a minute and
Mm.
don't necessarily need my dollars back. And I guess that's a question I have. Like,
Mm.
what is the commitment time frame? If I put my dollars in,
Yeah.
when can we expect those to return?
Yeah, that's the other part of it, which we think is good, but it's not like a highly liquid instrument, right? Like you
Hmm.
can't get out of 90 days just because we're doing, construction and rehab. So we have a 5-year fund that has potentially a 2-year, sunset to it, just depending on where projects close out. So
Hmm.
somebody comes in, it's more of a long-term commitment. And you got to know that we're building kind of a portfolio of these. And so that would be the time horizon. I think there's some ways to get out with some
Hmm.
minor penalties, but yeah, that's the
Sure.
time frame.
Yep. And I think that makes sense. Like that's the direction this is. And people need to be aware of that. Like
Yeah.
this is not your, Amazon stock or,
Yeah.
ETF bond funds that
Yep.
you can buy and sell today and tomorrow. So,
Correct.
okay. Yeah, no, I think that is great. Dave, is there anything else we should be thinking about, talking about before we wrap up?
Yeah. I think overall, I think we're at a really unique time right now where we're just excited about what we're doing because it's
Mhm.
really hard to get equity. And we're in this weird precipice, banks aren't really lending that much. They want tons of deposits. You've got, institutional equity on the side. So it's a great time, I
Mhm.
think, right now to be getting into the market because we think there's tons of opportunity that we're seeing. So,
Yeah. Yeah. No, and I just want to echo that. Like we've seen some lenders that were very aggressive when interest rates were really low, and
hmm
now I'll say, made some bad bets on how
hmm
they were investing their portfolio, and they had loans and their investments sort of not lining up from an interest rate perspective. And FDIC starts coming and looking closely, and putting the clamps on those organizations for making really any additional loans. Like we've seen some commercial lending departments completely shut down at banks. And it's
yep.
like, wow,
Oh,
okay,
yeah.
that's interesting. That's hard. We think about the economic engine of our country, and it's how freely cash flows, right? And
hmm
if the banks are shutting that down, I love that you're stepping into that gap, going, hey, we can help make projects work and get things off the ground and sort of keep our country going. So you're
Yeah.
doing a patriotic duty there. I
There we
appreciate it.
go. We're contributing to the US, right? It's, yeah, I mean, banks used to be 15,000 of them. Now we're at 4,000.
Hmm.
And it's just everything's kind of moving to that private world. And I think we'll keep seeing that.
Yeah, very good. And then on the other side of the equation, let's say we've got lots of real estate friends and
hmm
clients that are listening, that could be listening to this. If somebody's interested in, like, hey, Dave, I want you to take a look at our project, what is the process there? Obviously, they can email you, but is there a better way?
Yeah. You can reach out 602-367-8795. And we are actively wanting to deploy right now. So
Hmm.
we are, yeah, we're looking for deals. And those are the general tease points that we talked about, but
Yeah.
I would say we're active. So if someone wants to look at a deal, we're ready.
Wonderful. Yeah, that's great. And I mentioned before we started recording that I might have to reach out because we've got some
Sure.
projects we're working on, and this could be a great fit.
There
So,
we go.
you'll be funding one deal, and then I'll be putting money in as an investor on the other side. So
And
it's
we'll have
like
a
I can't.
podcast on the postscript, when it goes all well.
There we go. I love it. I love it. All right, Dave, this has been great. We will have all of your contact information
Thank you.
in the show notes. I think this was fantastic. And, I think about just the opportunity that you're
Mm,
presenting. I think there's opportunity to invest in these projects. We're keeping the risk profile as low as possible, but
hmm
we get to enjoy the benefit
Yep.
of the upside, which is the best of all worlds.
Yep.
So I think that's great. And we think about the wealth building in general that can generate. And when we don't take advantage of those opportunities that have, you know, anytime I have a floor on my downside and I've got almost unlimited upside, I like those risks. That's fun. I think about Nassim Taleb came out with a book called Anti-Fragile, and he likes those bets, right? Like there's a floor to my downside, and
Mm-hmm.
there's no cap to my upside. Like those are fun. And so I think you've done a great job putting together opportunities like that.
Yeah.
And so we just appreciate that. And then on the other side, if you're making poor investments, like where you're taking on lots of risk without a ton of upside, I look at a good example. Some of the revenue numbers that are coming into, like sales figures coming
Mm,
into like Tesla and that type of thing, and the multiple they're trading at, they
hmm
would have to shut off operations, not buy any raw materials. And it's still going to take you a decade for them producing the same revenue without any employees or any raw materials to get your money back. And I'm like, in
Mm,
what world does that investment make any sense? Like,
wow.
there's not much upside there and lots of potential downside. And so I appreciate you bringing opportunities like this to the marketplace. I think it can make somebody, really sort of transform from the average investor to the accredited investor that they are, right? Like that needs to be, they got to be over that threshold, but like, hey, there's some real wisdom to taking advantage of these opportunities. So thank you. I appreciate it.
Yeah, thank you. And yeah, it's interesting in the stock market because it's almost this story narrative that you're trying to buy into as opposed to
Mhm.
like being able to, in fact, I had a friend who was on the board in a company he owned as the top guy. And he said, I still don't know what's going on. I thought that's not good.
Yeah, yeah,
So yeah,
absolutely. Good stuff. All right. Thanks so much, Dave. I
thank
appreciate it.
you.
Thanks so much for tuning into this episode of the Vital Wealth Strategies podcast. I truly hope you found value in this conversation with Dave Kotter. Whether you're thinking about accessing capital for your next real estate deal or looking for a smarter way to grow and protect your wealth outside of Wall Street. If this episode sparked any ideas for you or reminded you of someone who needs to hear it, go ahead and share it with them. The more we can equip each other with smart strategies and real-world insight, the bigger the effect we can create together. And before you go, don't forget to visit vitalstrategies.com/tax. It's where you can start mapping out your custom tax strategy and unlock tools that help you keep more of what you earn. If you're serious about building long-term wealth the smart way, this is the place to start. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. And you're vital to me because you're committed to growing your wealth, leading with purpose, and creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you and look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives. Take care, and we'll see you soon.